Good morning, good afternoon, or good evening, depending on where and when you were plugging into this.
Welcome back.
It is Friday, February 13th, 2026,
Mm.
and yet it's a Friday the 13th.
Yeah. The spooky date.
Usually that is a date, reserved for bad luck, horror movies, hockey masks, and things just generally going sideways.
For sure. But if you're an investor in Rivian Automotive, ticker RVN, today probably feels very, very different.
It feels a lot less like a slasher film and a lot more like a genuine turning point, a very calculated, very specific corporate pivot.
It definitely does. I think for a lot of people holding the bag on EV stocks over the last, 18 months?
Oh, yeah.
Every day has felt a bit like Friday the 13th. But today, today it represents a real shift. We're calling this a watershed moment for the company.
Absolutely. We're looking at the Q4 and full year 2025 earnings report. It dropped yesterday, February 12th, right after the market closed. And let me tell you, the reaction after hours has been, well, energetic is one word for it.
Explosive is another. It's been volatile, for sure, but in the direction investors have been praying for.
But here is the thing, and this is really the central tension we need to unpack today. When you look at the headline numbers, there is this massive contradiction just staring you in the face.
Right.
How on earth did a car company that sold fewer cars in the fourth quarter manage to post its first full year of positive gross profit? I mean, it feels like a magic trick.
It does. It feels like some kind of, accounting alchemy, like pulling a rabbit out of a hat.
Exactly.
But when you actually strip down the engine and you look at the mechanics of this report, it's not magic at all. It is a fundamental structural change in what this company actually is.
A pivot.
They are pivoting and they are doing it hard.
Okay, before we dive into that pivot, this analysis is brought to you by stockanalytics.ai. Get institutional-grade research on over 600 stocks for just $10 a month. Plus, request any ticker and download your own video analysis. Start your 7-day free trial at stockanalytics.ai. Now, let's get into it.
So, our source material today is the RIVN Earnings Analysis Report Generation. It's a dense document, covers the whole fourth quarter and the full fiscal year for 2025.
And just to set the stage for everyone listening, because, we live in this financial bubble sometimes.
Yeah.
What is the vibe out there in the broader world? It hasn't exactly been sunshine and rainbows for the EV sector.
Oh, no. The vibe is definitely chilly. We are still very much in what analysts have been calling the EV winter.
The EV winter.
Yeah. I mean, you have competitors that are genuinely struggling to keep the lights on. You have the legacy automakers, Ford, GM. They're pulling back significantly on their electrification targets.
They're delaying factories, canceling models.
Exactly, because they can't make the margins work. And on top of all that, you have a consumer base that is feeling the pinch of high interest rates. So it's an incredibly hostile environment to be selling expensive, luxury electric trucks.
Right. And yet, somehow, Rivian seems to have found a lifeline. Or maybe lifeline is too weak a word. It feels like they've built a bridge.
They have. And the mission of this deep dive isn't just to look at one quarter of numbers.
No.
We need to look at this report as the blueprint for 2026. Management is calling 2026 a transition year.
Ugh. Okay, so whenever I hear a CFO say transition year, I immediately clutch my wallet.
You're right.
It's corporate speak for, we're going to lose a lot of money and we really don't know when it will stop.
It is usually a big red warning label, but in this case, the transition is quite literal. They are shifting from being a hardware manufacturer, a company that just bends metal, to becoming a vertically integrated tech powerhouse.
From bending metal to writing code. I love that framing. Okay, let's unpack this because the numbers are fascinating. Let's start with the top-level view.
Let's do it.
Slide 1, the at-a-glance scorecard.
Right. So the first thing any investor looks for when that notification pops up on their phone, did you beat the street?
And the answer is a resounding yes. It's a double beat.
A double beat. That's the gold standard in earnings reports. You beat on the top line, your revenue, and you beat on the bottom line, your earnings.
So let's run the specific numbers. Consolidated revenue for Q4, it came in at $1.286 billion. The consensus, what all the smart people on Wall Street thought they would do, was $1.260 billion. So a clear beat on revenue.
It's not a massive beat, percentage-wise, but in this climate, any beat is a victory. It shows stability.
And on the bottom line, adjusted EPS, that's earnings per share, also beat expectations pretty significantly. The scorecard here lists this clearly. It's a beat in bold capital letters.
But we have to pause here. You and I, we have to be the adults in the room and contextualize that beat.
Okay.
Why did they beat? Was it because they suddenly sold an extra, 20,000 trucks out of nowhere?
I have a feeling the answer is no.
No. They beat because the bar was set incredibly low.
Oh, okay. Manage expectations.
Exactly. Analysts from places like Zacks, FactSet, they aren't blind. They knew the landscape. They knew that big federal tax credit, the $7,500 one. It expired on December 31st, 2025. They knew delivery volumes were going to be soft because of it, so they lowered their estimates, effectively grading Rivian on a curve.
So Rivian stepped over a lowered bar. But if you look at the market reaction, investors treated it like Rivian just won the Olympics.
Wow. The market breathed a massive, massive sigh of relief.
Oh, it was a frenzy.
Yeah.
In after-hours trading yesterday, February 12th, the stock surged. Was it about 15.7%?
Yeah, around there.
It jumped to around $16.70 a share, up from a close of just $14.
That is a violent move to the upside, and it tells you something really important about the positioning of traders going into the report.
What's that?
It tells you that a lot of people were positioned for a disaster. They were shorting the stock, they were buying puts, or they were just sitting on cash expecting a huge guidance miss or some kind of cash crunch.
Right. The sentiment was overwhelmingly negative.
Totally. So when the report came out, and it wasn't a disaster, and in fact showed incredible efficiency, all that money flooded back in. It was a classic relief rally.
Okay, but here comes the reality check. Even with that big 15–16% pop, where does that leave the stock for the year?
It leaves us underwater, significantly. Even with that jump, the stock is still down nearly 28% year to date.
Ouch.
Yeah. So if you bought on January 1st, 2026, you are still hurting. The EV winter sentiment still hangs heavy. One good quarter doesn't melt all the ice.
That's fair. A very fair point. We shouldn't break out the confetti just yet. But let's go back to that surprise factor. You said analysts had the bar low because of volume. But the actual surprise wasn't that they sold more cars than expected, was it?
No, not really. The surprise wasn't in the volume, it was in the efficiency. And more specifically, the mix of the revenue streams.
Okay, efficiency and mix. Hold that thought, because that leads us directly into what I think is the most mind-blowing part of this entire report. This is the pivot point we were talking about.
It really is. This is the whole story.
Slide 2, the engine of profitability.
This is it. If you only take one thing away from this entire deep dive, let it be the story on this slide.
The slot says, here's where it gets really interesting. And it's not wrong.
Yeah.
We all think of Rivian as the truck company. You know, the R1T, the R1S.
Yep. Cool headlights, off-road beast.
Exactly. Camping gear, the gear tunnel. But this report suggests we should stop thinking of them as just a car company and start thinking of them as, as a software company.
The data certainly points that way. I mean, if you just isolate the software and services segment, the growth is staggering.
In Q4 alone, software and services brought in $447 million. That is up 109% year over year.
It more than doubled in a single year. You just do not see that kind of growth in heavy manufacturing. That's a growth rate you see in, a Silicon Valley SaaS startup.
And for the full year 2025, $1.557 billion.
Yeah.
That's up 222% over 2024. I mean, there are standalone public tech companies that would kill for $1.5 billion in annual revenue with that kind of growth trajectory.
Absolutely. And the key thing to remember is the margins on that revenue are completely different from the margins on bending steel and stamping aluminum.
Right. Hardware margins are thin. Software margins are fat.
Very fat.
So where is all this money coming from? It can't just be people subscribing to Spotify in their trucks or, paying for better maps.
No, it's not just in-car entertainment. This is where the Volkswagen partnership becomes the golden goose.
The VW deal. We heard about this in late 2024, the joint venture they formed. But now we're actually seeing the receipts.
Literally, the report breaks it down. In the fourth quarter, the JV with Volkswagen contributed approximately $273 million to that segment.
Wow. $273 million. That's, what is that, 60%?
It's 60% of the entire software and services revenue for the quarter.
So nearly 2/3 of their tech revenue is just Volkswagen writing them a check.
In a sense, yes. But it's not free money. It's payment for services. Rivian is selling vehicle electrical architecture and software development services to the entire VW group.
I have this analogy in my head that I want to test on you. It's like a bakery.
Okay, I'm listening. A bakery.
So you have this amazing artisan bakery, that's Rivian. They make incredible bread, the R1 trucks. People love the bread, they'll line up for it.
Okay.
But making bread is hard, the ovens are expensive, flour costs go up and down. It's a tough business.
Very low margin.
Right. But one day they realize, wait a minute, our secret yeast recipe, the chemistry, the code that makes the bread rise perfectly every time, that's actually unique and incredibly valuable.
Yeah.
And they realize that the giant industrial bakery down the street, that's Volkswagen, they can't figure out how to make their bread rise properly.
That is surprisingly accurate. I'm thinking of VW's early software issues.
Exactly. So Rivian stops worrying so much about selling every single croissant themselves, and they start licensing the yeast recipe to the giant.
That is precisely what is happening. Volkswagen is the industrial bakery.
Right.
They have the scale, they have factories in every corner of the globe, but they struggled mightily with the yeast, the software. Their ID series vehicles had notoriously buggy, laggy software.
Everyone remembers that.
VW's own internal software division, Cariad, was a mess. Rivian has the software solved. They have a clean, modern tech stack.
So they're selling the recipe.
And that sale fundamentally changes the economics of the business because selling the recipe costs almost nothing once you've developed it. It's pure margin. And that brings us to the aha moment of the entire report.
The gross profit milestone.
Yes. For the first time in the company's history, Rivian posted a full year of positive gross profit.
It's $42 million.
$42 million. Now, I can already hear listeners saying, big deal, $42 million, that's nothing for a company this size.
Right. For a company valued in the billions, that sounds like a rounding error. It sounds like pocket change.
But you have to compare it to 2024. You have to look at the trajectory. Do you remember what the gross loss was in 2024?
I'm looking at the report right here. It was a gross loss of $706 million.
$706 million. They were losing that much money on the stuff they sold.
So they were losing thousands of dollars on every single truck that rolled off the line.
Exactly. So they swung the boat from losing over $700 million to making $42 million. That is a massive, massive turnaround. And it's almost entirely driven by those high-margin software revenues subsidizing the hardware ramp-up.
This sounds familiar. This sounds a lot like the Tesla playbook.
It is the Tesla playbook, but with a twist, a huge accelerator.
What's a twist?
Tesla had to build it all themselves. They had to sell millions of cars to get their software out there and achieve scale. Rivian is accelerating that process by partnering with VW. They're executing the playbook faster because they found a partner to pay for the R&D and distribute their tech.
It's brilliant. It really is. But it creates this weird contradiction when you look at the rest of the business. Because while the software side is popping champagne, the car side
is facing a harsh reality.
Let's go there next. Slide 3, the engine room business segment performance.
And this is what we're calling the automotive paradox.
It really is a paradox because software is booming, booming, booming. But the automotive segment revenue in Q4, it dropped 45% compared to the same time last year.
Wow.
It fell to $839 million.
A 45% drop is steep. That's almost half your core revenue gone in that segment year over year.
So if I'm an investor and I just see that headline auto revenue down by half, I panic. Why shouldn't I be panicking?
Well, you have to understand the headwinds that caused it. They were largely expected, but they still hit hard. The biggest one, by far, is that tax credit hangover we mentioned.
Right, the $7,500 federal credit.
That credit expired on December 31st, 2025. Now, when consumers know a big discount is going away, what do?
They rush to buy before the deadline.
Exactly. It caused a massive pull forward of demand into the third quarter. Everyone who was thinking of buying a Rivian in the next 6 months, they rushed to buy in July, August, September to lock in that credit.
Which left the cupboard completely bare for Q4.
Precisely. Q4 was the hangover after the Q3 party. Then you add in the second headwind, regulatory credits.
Ah, yes. The ZEV credits. The ones they sell to other automakers who aren't making enough EVs,
Sure.
right?
It's basically free money for a pure EV maker. That revenue stream almost completely dried up in Q4. It was down $270 million. That's pure profit that just, poof, vanished from the quarter's results.
Okay, so that's a big hit. What else?
And finally, there's the delivery mix. We talked about this a little bit earlier. They sold a lot more of the electric delivery vans, the EDVs, to their big partner, Amazon in Q4.
You see them everywhere now. It feels like every Amazon delivery is in one.
They are, and that's great for volume. It's great for keeping the factory utilization rate up. But an Amazon van is a commercial vehicle. It sells for less money than a fully loaded quad-motor R1S luxury SUV.
So the average selling price, the ASP, takes a hit when you sell more of the cheaper vans.
Exactly.
Okay, so let me get this straight. They sold fewer cars overall. The cars they did sell were on average cheaper vans, and the free government money dried up. That totally explains the revenue drop. And here's the part that I'm still struggling to wrap my head around. If they sold fewer cars, how did they make money on them? How did they get to gross profit positive?
They fixed the factory.
They fixed the factory.
This is the re-engineering story. They didn't just slow down production. They used that time to completely overhaul how they build the vehicle in Normal, Illinois. The report highlights a 30% drop in the cost of goods sold the KGS per unit.
30%? That is not a small tweak. That's a revolution in manufacturing terms. How in the world do you cut 30% out of the cost of a complex truck in 1 year?
It's a multi-pronged attack. First, you negotiate. Hard. The report says they renegotiated 75% of their supplier contracts.
So they went back to everyone who sells them parts and said, we need a better price.
We need a better price or we'll find someone else. But more importantly, they simplified the physical truck itself. The report specifically mentions the electrical harness.
The what?
The entire nervous system of the car. In the first generation R1, it was incredibly complex, it was heavy, it had tons of copper, and it required a lot of manual labor to install on the line.
I remember hearing stories about that.
In the Gen 2 models, they stripped that down. Less copper, fewer connectors, a more logical layout that's faster to install by robots and humans.
So less stuff in the car means it costs less to build.
And fewer hours of labor to put it all together. And here is the real kicker.
Okay.
Even though the average selling price dropped because of all the vans, the actual consumer vehicles, the new R1 Gen 2s, are selling for 10% more on average.
Wait, so the vans are dragging the average down, but the trucks people actually buy are more expensive now?
Yes, because people are paying a premium for the new high-performance quad-motor models. They want the best of the best. So Rivian is squeezing more profit out of the top end of their market while using the Amazon vans to keep the lights on at the bottom end.
That is a very delicate balancing act to pull off.
It is, but so far it seems to be working.
I also noticed a little blurb in this section about service and remarketing.
Yeah. Brief, but it's becoming more important. They have 97 service locations now, plus 700 mobile service vans. As the fleet of Rivians on the road grows, fixing these cars becomes a real recurring business.
An annuity stream.
Exactly. And remarketing. That's just a fancy word for selling used Rivians that come off lease or as trade-ins. That's starting to contribute real cash to the bottom line as well.
They're selling used cars. It's a real car company now.
It is. They have to deal with trade-ins and service appointments just like Ford or Toyota.
Okay, so operationally, they are tightening the screws and getting much, much more efficient. But let's talk about the fuel in the tank, because in the car business, cash is oxygen. If you run out, you're done. Slide 4. Financial strength and shareholder rewards, or as I like to call it, the liquidity bridge.
It's a bridge, for sure, and it is arguably the most important structure Rivian has built in the last year.
So let's look at the bank account. They ended 2025 with $6.08 billion in cash and equivalents.
Which is a lot of money by any standard.
It is a lot of money, but it's down from $7.7 billion at the end of 2024. So they burned through about $1.6 billion last year.
Which, for an auto startup that is still scaling up and investing heavily, is actually a slowing burn rate. But you're right, the number went down.
So why isn't the market panicking about that? Usually when a company burns through $1.5 billion, investors get very nervous.
Because of the Volkswagen Lifeline.
It's a lifeline.
This is why that partnership is so critical. It's not just about the software revenue we already talked about. It's about direct capital injection. The report details that Rivian is expecting another $1 billion from VW in October as debt.
Okay.
Plus another $1 billion in future milestone payments tied to the JV.
So that's $2 billion of incoming cash that isn't even on the balance sheet yet.
Exactly. That money acts as a bridge. It gets them all the way to the R2 launch without needing to go out to the stock market with a tin cup and beg for more money from investors.
Which would be a so-called dilutive offering. It would dilute the current shareholders.
Right. An equity raise right now, with stock price still depressed, would be incredibly painful for existing shareholders. This VW cash allows them to avoid that. It buys them precious time.
I also noticed on the balance sheet that their inventory is down.
A very positive signal. A subtle but important one.
Why is that a good thing?
It means they are clearing out the old stuff efficiently. They aren't sitting on a giant parking lot full of unsold 2024 models or old parts. It shows that they're getting really good at matching their production to actual demand. They're not just building cars and hoping someone buys them.
That's a sign of a mature operation.
It is.
And what about CapEx capital expenditures? They spent a hefty $1.71 billion in 2025.
Yeah.
Where is that money going if they aren't building brand new factories?
Well, they are building just inside the existing walls of the Illinois plant. That money is going into R2 tooling. They're buying the robots, the stamping presses, the assembly lines for the new, more affordable SUV. And a chunk of it is also going to build out the new RAP1 chip plant.
The chip plant. We will definitely get to that in a second. But before we get too optimistic, we have to play devil's advocate. What is the bear case here? What are the skeptics saying?
We must be fair. The balance sheet isn't perfect by any stretch. Total liabilities are up to $10.27 billion.
That is a big number.
It is. And the debt-to-equity ratio is rising. This is what firms like UBS and Wolfe Research, who are cited in this report, are pointing to. They remain very cautious, or even bearish.
And their argument is what?
They're essentially saying, look, the debt load is getting heavy, and if the R2 doesn't sell like hotcakes right out of the gate, this bridge to profitability might not be long enough. It might lead to nowhere.
So the stakes are incredibly high.
The stakes are everything. The company is betting its entire existence on the success of the next 18 months.
Which brings us to the main event, the future. Slide 5. The road ahead management's outlook and key takeaways. Everything, absolutely everything rides on the second quarter of 2026. The launch of the R2.
The R2 midsize SUV. This is the ballgame.
This is the car that changes everything for them, right? I mean, the R1 is an $80,000, $90,000, sometimes $100,000 truck. It's a niche product for a wealthy buyer.
For sure.
The R2 starts at, what did the report say?
Around $45,000.
$45,000, okay. That puts it right in the throat of the Tesla Model Y, the Ford Mustang Mach-E, the Hyundai Ioniq 5. This is the mass market.
This is the volume segment. This is where you go from selling tens of thousands of cars to potentially hundreds of thousands. And the timeline is tight. The report says production validation builds were completed in January 2026.
So what does that mean?
That means they are building real sellable cars on the final production line right now just to test everything. It's the last step before they flip the switch.
And the full public reveal is March 12, 2026. That's less than a month away from our fictional date here today.
And the early buzz is strong. The report quotes some early media reviews, and one of them says it is quite possibly the best all-around EV.
High praise. But to compete at $45,000, you have to be ruthlessly efficient. You can't just throw money at the problem. And this is where the secret sauce comes in.
The technology roadmap. This is the vertical integration story.
Specifically, the RAP1 chip and the autonomy software.
Right. This connects all the way back to the software story we started with. Rivian isn't buying off-the-shelf chips from NVIDIA or Intel for this car. They made their own.
The RAP1 processor.
In-house silicon.
Why bother? Isn't chip design incredibly hard and expensive? Why not just buy from NVIDIA like almost everyone else?
It is incredibly hard. It's a huge bet.
Right.
But if you can pull it off, the benefits are massive. First, and most obviously, is cost. It's much cheaper in the long run to make your own chip than to pay NVIDIA's hefty margin on every single one.
Okay, cost savings. What else?
Second is integration and efficiency. When you design the chip and the software that runs on it together, in the same building, you get incredible synergies. You can optimize for much better performance.
And better efficiency in the computer means better range for the car.
Exactly. Less power draw from the central computer means more of those precious electrons can go to the wheels. It's a key to unlocking more range.
And then there's the subscription model they're building on top of this chip. Autonomy plus O.
This is the recurring revenue dream for any hardware company.
And they are pricing it very aggressively. The report says it's a one-time fee of $5,000 or $99 a month.
Now compare that to Tesla.
Tesla's FSD, their full self-driving package, is what, roughly $8,000 one time now, or $199 a month?
Something like that. So Rivian is undercutting them by nearly half.
Why would they do that? Why leave money on the table?
It's a strategic choice. They want a higher attach rate. Yet the percentage of buyers who opt into the feature, they would rather have, say, 50% of their customers paying $99 a month than only 10% of customers paying $199. They want everyone in the ecosystem.
That makes sense. Get the volume up. And they're also adding this Rivian assistant.
Agentic AI. This is the next level of in-car assistant.
Rivian Unified Intelligence. It sounds like something out of a sci-fi movie. The report says it manages your calendar, it's context-aware, so it's not just, hey, Rivian, play the Beatles.
No, it's more like, hey, you're running late for your next meeting. Should I send a message letting them know and start navigating to the office? It's about turning the car into a true digital assistant.
So, okay, we have the new car, we have the new chip, we have the new AI. What does 2026 actually look like in terms of numbers? What is the official guidance?
This is where we need to manage our expectations carefully. The guidance is for 62,000 to 67,000 deliveries for the full year.
That represents, right, a 52.7% increase over 2025? That seems like really healthy growth.
It is, but you have to look at the cadence, the timing. Management is guiding for a J-curve.
A slow start, then a sharp ramp.
A very slow start. The first half of the year, H1 is expected to be only 9,000 to 11,000 cars per quarter. That's actually pretty low, lower than what they were doing before.
Why so slow?
Because they're shutting down the production lines for periods of time to retool for the R2. They're installing all those new robots we talked about. Then, in the second half of the year, H2, the massive surge hits when R2 comes online.
So the message from management is, if we see some ugly delivery numbers in Q1 and Q2 of 2026, we shouldn't freak out.
Management is screaming from the rooftops right now, do not freak out, it is part of the plan.
But the financials for the year? We should probably expect some red ink.
Oh yes, they are guiding for an EBITDA loss of between $1.8 billion and $2.1 billion.
So they're going to lose a lot of money this year, even after just hitting gross profit positive.
Yes, and that is why they call it a transition year. Margins will dip again briefly. It costs a tremendous amount of money to turn on a new factory line. You have to hire people, train them, run the machines, but you aren't selling the cars yet. That period just eats cash and kills margins.
So the message to investors is, hold on tight, ignore the bumps in the first half of the year, and wait for the rocket ship in the second half.
That is precisely the bet that the market is making today.
Okay, we've covered the slides, but I want to do a little deep dive discussion on the macro stuff, the vibes, the sentiment.
Let's talk vibes.
Who is buying and selling this stock? Because when I look at the insider activity section of the report, it makes me a little nervous.
You notice the sales from the executives.
Yeah. CEO R.J. Scaringe and the CFO, Claire McDonough, they both sold shares recently.
It did.
Now, I know. Executives get paid in stock. They have a 10b5-1 plan. They have to sell to pay taxes, diversification. I get all that. But yeah, it doesn't look great, does it?
It's never a great look when the captain and the first mate are selling some of their shares while telling everyone else the ship is about to speed up.
Right. It just feels off.
But we have to be nuanced here. It is very likely just standard financial planning. If 99% of your entire net worth is tied up in one volatile stock, your financial advisor is probably screaming at you to sell some.
That's a fair point.
But you are right. The skeptics and the bears, they see that as a lack of conviction. They ask the simple question, if the R2 is going to be such a huge hit, why would you sell now at $14? Why not wait until the stock hits 30 or 40?
Exactly. It just feeds the doubters. And there is a real clear divide among the Wall Street analysts right now, isn't there?
A massive divide. You have the optimists, and they are laser focused on the unit economics. They see the COGS dropping 30%. They see the high margin software revenue. They see the BW deal, and they say, this is a tech company trading at a discount.
And on the other side, the pessimists.
The pessimists, like the analysts at UBS mentioned in the report, they just look at the cash burn. They look at the rising debt. They look at the overall EV winter, and they say, this company is still going to lose $2 billion this year on an EBITDA basis. That bridge they built is shaky, and a lot has to go right.
Let's talk about that EV winter for a second. Is Rivian insulated from it at all, or are they just as exposed as everyone else?
I think they're better insulated than most, for a couple of key reasons.
Okay, why?
First, that Volkswagen partnership gives them global supply chain power they could never have on their own. When VW goes to buy steel or batteries or microchips, they get the best price in the world because of their volume.
And Rivian now gets to piggyback on that purchasing power.
They get bulk pricing without being a bulk buyer. It's a huge competitive advantage. Second, they are very focused on North America. They're building in Illinois primarily for the American market. That helps them avoid some of the messy tariff wars happening with Chinese EVs in Europe and elsewhere.
That's a really good point. It's a geopolitical hedge.
A very important one right now.
So as we wrap up this deep dive, I have a final provocative thought for you. And for you listening. Is Rivian still a car company? Or did they just become a software company that happens to use cars as a delivery mechanism?
That is the multi-billion-dollar question, isn't it?
I mean, think about it. They have their own custom silicon, the RIP1 chip. They have the Autonomy Plus subscription service. They have the massive VW software deal, where they are essentially the Microsoft of EVs for the entire Volkswagen group.
And the car, the metal, the rubber, the glass, that's just the expensive hardware dongle that you need to buy to run their software.
Exactly. It's the iPhone model. Apple makes a ton of money on the App Store and services, but they need you to buy the phone first. Is the R2 just the iPhone for Rivian's software ecosystem?
If you believe that thesis, then the current stock price is dirt cheap. If the metal is just the Trojan horse for the code, then the margins and the profitability we're seeing today are just the tip of the iceberg.
The Trojan horse for the code. I love that. It's a fascinating way to frame the entire company.
It changes the whole investment thesis. You aren't just betting on how many trucks they can sell, you're betting on how many subscriptions they can sell over the lifetime of those trucks. It becomes a whole different ballgame.
Well, we will see if the R2 is the hit they need it to be. March 12th is the reveal. We'll be watching very closely.
We certainly will.
That brings us to the end of today's deep dive. Just a reminder, this is not financial advice. We are just two people reading a report from the future and talking it through. Please do your own research. And this content was generated by AI.
Always do your own due diligence before making any investment decisions.
Want institutional-grade stock research without the institutional price tag? Check out stockanalytics.ai. For just $10 a month, you get full access to our deep dive video library covering over 600 S&P 500 and NASDAQ 100 stocks, each with full source citations you can verify. Can't find the stock you're looking for? Request analysis on ANY ticker and download your own video within 24 hours. Upgrade to Pro for $20 a month and unlock our SEC Risk Scanner, which detects red flags in company filings before they hit the headlines, plus our Portfolio Diversification Analyzer to optimize your holdings. Start your 7-day free trial today at stockanalytics.ai. Make smarter investment decisions with research you can trust. Thanks for listening, everyone.
See you next time.